One of the simplest forms of investing is to make a regular payment every single month into an exchange traded fund or a bond. This usually yields the greatest return over a long period of time as it tracks a general market instead of individual stocks and shares. We're going to be using this formula and I'm going to first lay out what each one means. So X would be the amount invested, and we're going to pick £200 initially, and that's going to be how much is going to go in every single month. The only assumption we're going to make is for the annual return, which is going to be I, and we're going to pretend that that's going to be 6%, which is around the average amount over a 10-year period that an exchange traded fund or government bond increases. I think it sometimes fluctuates between 7 and 8%, but that's I'm going to take a low average. We're going to convert that into a decimal. 6% is a decimal is 0.06. The period we're going to look at, is going to be 10 years. But we're going to have to convert that into months because we're going to be making an investment of £200 every single month. So how many months are there in 10 years? There are 120. And this here is going to be our value for N. And then finally, we need to now know how much the interest rate compounds per month instead of per year, because that 6% is annually. So to find out the monthly interest, we're going to take this percentage of 0.06 and divide it by how many months there are in a year, which is going to be 12, and that simplified is 1 over 200. We now have everything we need to begin to plug in to this equation. So let's do that. So total will equal 200 times 1 plus 1 over 200 to the power of 120 minus 1, all divided by 1 over 200 times 1 plus 1 over 200, which is very, very nominal. That's a really small value, just above 1. So in some calculations, you don't even need to put this n bit in, but it gives it a little bit of greater accuracy, and it will make it closer towards the final value. So first, let's simplify everything here. So that's going to be 200 times 163.879348. And that's going to be times by 1 over 1 over 200. And then that answer is going to be 32,939.75. But we've invested 24,000 over that period, which results in 8,939.75p as profit. So £24,000 invested over 10 years. This could be in dollars or pounds. It doesn't really make a difference. And then the return is going to be 8,939. Let's see what the difference is if we do 20 years. So if we're picking 20 years, it's going to be the exact same thing here. We're going to pick this equation. However, the number here is going to change. So instead of there being 120 months, it's going to be 240 months. So 200, 1 plus 1 over 200 to the power of 240 minus 1, all divided by 1 over 200 times 1 plus 1 over 200. The answer to this is going to be 92,870.22. In that period, you've invested 48,000. So the profit is 44,870.22. What about 40 years? So in 40 years, I'm not going to fill it out all again. You're going to have 400,289.64. However, the invested amount is 96,000. So the profit is 304,289.64. So it's pretty drastic as we get closer towards the end, compared from 10 years where the profit is 8,900. Then the following 10 years, there's almost 30,000 plus pounds more being made. I'd say closer to 40,000 almost. And then in the last 20 years, you can see that there's a drastic exponential increase. Let's see how that looks graphically. With the graph, we can really show the power of compound investing. So as we saw, after 10 years, you're going to have about £32,000, 940 back. So if that's 100k, that's 50. So let's say 10, 20, 30. It's going to be about here is how much you're going to have back. You'll have invested £24,000 at that point. Then let's see what the return is after 20 years. Is going to be 92,000. So you're going to have somewhere about here. We didn't do 30, but you can see for 40, the amount that's going to be coming back is going to be all the way. Let's follow that up. About here. So what's happening, this is going to be pretty terrible, but the graph is becoming an exponential as it goes vertical. So you can see that the line is going to go up like this, and it's going to keep going. So the longer you hold, this period is where you're going to get the biggest gains. So that's really showing how holding is more important than short-term selling. And hopefully you've learned how to invest with regular monthly payments and how that will impact your return.